The recent multi-billion-dollar repricing in the technology sector is a mathematical structural correction. It is a calculated reset driven by the physical limits of capital, entirely separate from any temporary retail market panic. This chart tracks the immediate fallout. Over hours, major indices recorded a sharp plunge, wiping hundreds of billions from the Nasdaq and semiconductor index. The variable driving this drop appears on the secondary axis, the steep upward trajectory of big tech's projected AI capital expenditures. The mechanism forcing the market to reprice is a violent collision. Astronomical cash requirements for infrastructure are hitting a highly restrictive macroeconomic environment head-on. To understand the math, we first have to map the internal mechanics of this CapEx strain, tracking exactly how physical AI deployment is draining corporate cash flows. Second, we must examine the external macroeconomic pressures, specifically how rising government bond yields are compressing the valuation of these cash-poor tech firms. Finally, we can track the resulting institutional capital rotation. Smart money is actively moving out of experimental software and deploying directly into the foundational physical infrastructure powering the grid. The ongoing repricing of tech equities is a mathematical inevitability based on the physics of capital allocation. It operates entirely separate from the long-term utility or eventual success of artificial intelligence itself. Artificial intelligence requires absolute physical reality to function. Before a single algorithm can run, companies must acquire massive volumes of raw materials, commercial real estate, industrial cooling systems, and specialized microchips. In corporate finance, the metric used to track these massive physical build-outs is capital expenditure, or CapEx. We can visualize the impact through this split-screen financial model of a corporate cash flow statement. On the left, we track cash outflows, our CapEx. On the right, we track cash inflows from consumer revenue. These two figures merge to produce the bottom line, free cash flow. Right now, tech giants are committing hundreds of billions to the CapEx outflow side. Meanwhile, consumer AI software revenue on the right remains relatively stagnant. This severe imbalance drives the bottom line free cash flow deeply negative. Moving from theory to real-world data, major players across the sector are currently executing this exact cash burn strategy. Oracle serves as an immediate case study for this dynamic. The company recently announced a staggering $56 billion capital spending initiative specifically dedicated to infrastructure. The immediate mathematical consequence of committing that much raw cash to hardware is that it forces Oracle's free cash flow directly into the red. This creates a severe operational risk. The pace of advancement means that current, highly expensive AI hardware could easily become technologically obsolete long before it generates a single dollar of retail profit. Looking at this data, Wall Street risk managers are adjusting. As macro strategist Eric Johnston recently stated, the active institutional trade right now is to sell the spenders. Deep negative free cash flow creates a ticking clock. The physical AI infrastructure is now forced to generate massive, immediate financial returns simply to justify the cost of its own construction. When consumer revenue cannot cover the CapEx shortfall, tech companies face a secondary problem. They must issue massive amounts of corporate debt to fund the physical build. We can observe this rapid cash consumption across the broader tech landscape by looking at SpaceX. On June 12th, SpaceX went public with massive fanfare, pulling in $85 billion. Yet, just days after that massive influx of capital, they announced a $20 billion bond sale to raise even more cash. The rapid pivot to the bond market implies that even the most highly valued, high-profile technology companies are navigating a severe operational cash crunch to maintain their infrastructure targets. This internal debt problem is heavily compounded by the external macroeconomic environment directed by the Federal Reserve. Under the new Fed chair, Kevin Warsh, monetary policy is executing a hawkish pivot. Warsh has signaled potential interest rate increases to combat sticky inflation. Every upward adjustment to the federal funds rate directly increases the baseline cost of capital for all new corporate debt. Consider this balance scale visualization. It models the formula compressing market valuations. On one side, we place high-growth tech equities carrying heavy corporate borrowing costs. On the other side, we place the risk-free rate, represented by the U.S. 10-year Treasury yield. Watch the scale as the 10-year Treasury yield climbs, eventually hitting the critical 4.5% threshold. This visually represents the institutional logic behind the equity risk premium. When the government guarantees a 4.5% risk-free return, allocating capital to highly overvalued, cash-burning tech stocks becomes mathematically unviable for risk managers. The combination of massive debt required for CapEx and highly attractive risk-free government yields forces a severe compression in market valuations, regardless of how innovative a tech company's product line might be. The market reality is that institutional capital is not fleeing the broader stock exchange entirely. Instead, risk managers are executing a highly calculated sector rotation. Capital is being actively pulled out of experimental, high-burn AI software companies operating with negative free cash flows. That same capital is quietly flowing directly into entities that provide foundational, physical utility. The primary beneficiaries of this rotation are hardware manufacturers, companies building backup power generators, managers of local energy grids, and designers of industrial cooling systems. This decision matrix outlines the strict new criteria that institutional smart money is using to allocate capital in a high-rate environment. Criterion 1 is real earnings. Institutions require positive current cash flow today, completely discarding abstract projections of future software dominance. Criterion 2 is solid pricing power. Capital is moving toward companies that can defend their profit margins and pass costs onto clients, even in an inflationary environment. Criterion 3 requires concrete infrastructure ties. A company must be directly integrated into the physical expansion of data centers and the actual energy grid. Blindly buying the dip on legacy tech companies simply because they cite AI exposure in their earnings calls is a severe risk if they lack the underlying fundamental financials to support their capital expenditures. In the next phase of the market, sustainable growth no longer relies on speculative software models. It relies entirely on the fundamental financial viability of the physical infrastructure required to power them.